What's up everybody, GenExDividendInvestor here. In this video I'm going to show you some fascinating dividend growth data trends, including a new record we broke in 2021 and one we expect to break in 2022. So if you're like me and you're annoyed with YouTubers who ask you to hit the thumbs up button, subscribe if you haven't yet, and click that bell notification, then you'll be pleasantly surprised to find out that I won't be asking you to do that. I mean, you should do it, but I won't be asking it. Okay, now some of the data I'll be sharing in this video is from Janus Henderson, a British asset management group that has been doing a long-term study into global dividend trends across the 1,200 largest firms by market cap in the world. But first I have a fun guessing game for you. Guess how much dividends were paid out by US companies in 2021. 4 possible answers that you can choose from, and they are 5 billion, 50 billion, 500 billion, or 5,000 billion. Don't cheat and look it up. Just pause the video and leave me a comment with which of those 4 answers is your guess as to about how much was paid out. I actually asked the same question on my Twitter account. About 7% of the people guessed $5 billion, almost 42% guessed $50 billion, 29% guessed $500 billion, aka a half trillion, and 22% guessed $5 trillion. We can find the answer in this chart from Janus, which breaks down dividends paid out by industry per year in the US. What they call industry, I would call sectors, but hey, what do I know? So in 2021, the total dividends paid out in the US across all sectors was $522 billion, which means that 29% of the people in my Twitter poll guessed correctly. How did you do? Thanks for guessing if you did. Think about how amazing it is that $500 billion was paid out to shareholders. Man, I love those irrelevant dividends. It still makes me giggle when people say that. Well, sometimes I get sad because I know they're missing out, but other times I can't help but laugh. Anyways, it's even more amazing to consider that most companies kept paying dividends even through the once-in-a-lifetime pandemic. Well, I mean, I hope it's once in a lifetime. We can see that in 2015, consumer basics paid out the most at $63.3 billion. Right behind it was financials with $63.2 billion. Then technology was third at $57.7 billion. And healthcare was the 4th highest paying sector at $45 billion. If we jump over to 2021, we see that the sector paying out the most in the US is now financials at $102.2 billion. Second most is technology at $91.2 billion. Third is healthcare at $75.5 billion. And fourth is consumer basics at $62.4 billion. You can look at these trends to get a broad sense of how companies in each of these sectors perform in aggregate. Let's look at technology. $57.7 billion in 2015, $64.9 in 2016, $67.4 in 2017, $77.6 in 2018, $78.9 in 2019, $90.8 in 2020, and $91.2 in 2021. That means it increased by 58% over those 6 years, which means the average dividend CAGR across tech companies was around 8% over that time period. We also see that tech went from paying the 3rd most dividends in 2015 to 2nd most in 2021, so it's trending higher. That makes sense intuitively since tech has been a powerhouse growing industry, which I'd anticipate will continue to grow faster than the norm. In fact, Janus said that in 2021, technology payouts were more than 4 times larger than in 2011, increasing their share of the US total dividends paid out from 1/10 to 1/6. Technology companies also have relatively low payout ratios, meaning they distribute a smaller share of their profits than some of the more traditional sectors, which is another reason why people anticipate that good tech companies will have very powerful long-term dividend growth histories. And those are some of the reasons why I like to have Apple and Microsoft as the 2 biggest positions in my dividend portfolio. Janus said, and I'll quote, "Technology dividends have become the biggest driver of long-term growth, accounting for a quarter of the increase in US payments in the last 10 years. They also said that the technology sector has some very large companies which emerged as hugely cash-generative businesses after years of steady investment. As a result, their dividends have grown in importance." Okay, each sector can be interesting to review. Like consumer discretionary. They paid out $30.9 billion in 2015, $31 billion in 2016, $30.4 billion in 2017, $31.3 billion in 2018, $33.8 billion in 2019, and then a big drop to $24.7 billion in 2020 during the pandemic, and then $26.5 billion in 2021. Remember, discretionary products are considered non-essential by consumers, but desirable if their available income is sufficient to purchase them. So you'd expect that during a pandemic that discretionary stuff could materially fall. Consumer basics in 2019 was $57.1 billion and actually went up to $63.1 billion in 2020. So no negative impact to stuff you need, but you can see consumer basics has some lumpy dividend payouts over the years. Financials is almost always a powerhouse, other than during mega crashes like the '08 financial crisis. But we can see that in 2015 it was at $63.2 billion of dividends paid out in the US, which rose to $71.3 billion in 2016, $78 billion in 2017, $87.5 billion in 2018, $96 billion in 2019, $97.8 billion in 2020, and $102.2 billion in 2021. So it went from being the second highest payout sector in 2015 to the highest payout sector in 2021, and it increased at a bit over 8% annualized CAGR. Healthcare's had a nice trend as well, increasing from $45 billion in 2015 going up to $75.5 billion in 2021. Or you can look at steady Eddy utilities that just gradually trended up from $19.1 billion in 2015 to $26.9 billion in 2021. I like to call utilities the bonds of my portfolio because they're slow and reliable and have a low beta, but obviously they aren't as safe as some bonds. If you look at how much total US dividends were paid out in 2019, we see $491.7 billion went out. Then in 2020, when the pandemic started, $505.1 billion were paid out. Which means that even in the worst pandemic in any of our lives, dividends were still paid out and even increased overall. That shows you how important dividends are to most business owners. From 2020 to 2021, the overall dividend payout increased by only 3.5%, but hey, it still went up, which explains part of the reason why I have confidence in owning a diversified portfolio of decent dividend companies. Okay, Janice broke down their sectors by industries so you can get even more detailed insights into trends. So looking at technology, we see that companies fall into three broad buckets of industries: in IT hardware and electronics, in semiconductors, and in software. If you look at the trends, you can see that semis and software both about doubled over those 6 years, whereas IT hardware only went up around 20%. Or like in industrials, you can see how aerospace and defense has been trending versus how transport has been trending. Feel free to screenshot this or use the link in the description of this video to see all the data. Okay, here's a breakdown of dividends paid out by US companies per sector on the left versus dividends paid out by international companies by sector on the right from 2017 to 2021. One interesting observation is that financials were 19% of US dividend payouts from 2017 to 2021, whereas they were a monstrous 45% of the rest of the world. So I think all those banks around the world, like in Canada, China, England, Australia, and beyond, collectively represent a large portion of international dividend payouts. Another observation Janice had was that mining dividends were a nice driver of global growth in 2021. The US mining sector is relatively small compared to other countries like Australia and the UK, but it too has benefited from the commodity boom. Okay, here's another view that shows US total dividends paid out from 2009 to 2021, and you can see that Janice estimates that in 2022 we'll hit another new dividend payout record. They estimated that 2022 will be a banner year and dividend payouts should increase by 7.5% overall to $562 billion. Yes, please, may I have another? That's what she said. Sorry you have to put up with my 16-year-old maturity. Regardless, it's all this sort of data that helps explain why I felt confident enough in my dividends to retire early and let dividends take over paying the bills. If enough of my dividends stopped providing me with cash flow, then I'd need to go back to work, assuming I didn't resort to selling stuff. But if I had to take a bet on either a job paying my bills or my dividends, I'd bet on my dividends. Which I literally did. Let me tell you about some of the companies I've worked for over the decades to help you understand why I feel stronger about a diverse portfolio of dividend stocks than I do in job income. I worked at my first company for a few years and decided to leave when a relative recruited me to join a startup. The company I left eventually got bought out, and I heard that they unfortunately let a bunch of people go. And then even that company got bought out by someone else, and again a bunch of people got let go, and the new company ended up shutting down offices in my state altogether. The startup I went to did well until the dot-com crash. Fortunately, I got recruited by a more established company before the crash, so I avoided the pain of being part of a startup that completely went broke. The new company I was at did well, and then it got bought out by a bigger company, so again some folks got laid off. I ended up working there for quite some time until I quit to take on a bigger role at a smaller company, and the company I left ended up getting acquired, and again a bunch of people got let go. The smaller company I was at did well until they merged with a bigger company, which ended up feeling like an acquisition instead of a merger because the bigger company fired a ton of people that they merged with. My point in all that is even though I was someone who overall did great on performance reviews and got lucky leaving companies shortly before they went belly up, not because I could see any problems they were coming, but just because I was trying to move up in my career, I've seen way too many companies leave a wake of bodies behind them. Your job often allows you to survive, but usually not thrive. And the reality is sometimes they don't even do a good job letting you survive. All those working experiences helped shape who I am today, and they're probably part of the reason why I believe in investing so much, because you just can't rely on job income alone. Sure, oftentimes it can work out, but I've seen countless times where great people got axed for no fault of their own, so you gotta have other income sources flowing in to protect yourself. Of course, dividends are not guaranteed either. Outside the US, dividends fell by around 12% during the 2020 pandemic year, with the UK and Europe facing the worst dividend cuts. Janice said that about 2/3 of companies around the globe increased their dividends or held them steady in 2020, but 1 in 8 canceled its payout altogether and 1 in 5 made a cut. A guy named Inversionista Incognito responded to my Twitter poll saying that where he is from, companies must pay at least 30% of their earnings as dividends. So if your earnings are volatile due to things like the pandemic, then your dividend payouts can be volatile as well. US companies tend to pay fixed amounts of dividends per share you own, so it's often a more reliable and non-volatile payout. Owning international stocks as a US investor also means you deal with volatility from currency fluctuations. Janice also said that in North America, companies were able to conserve cash and protect their dividends by suspending or reducing share buybacks instead. That's actually another nice thing I like about share buybacks, which is that they can act like a protective slush fund for dividend payments. Management often prioritizes dividend payments to their shareholders over buybacks and thus can scale down buybacks to keep the dividend flowing. Okay, here's a chart of the top 15 dividend payers in the US in 2021. Note, I'm long almost everything in this list. We see that Microsoft is on top and paid out $17.3 billion in dividends. That means that Microsoft is now responsible for $1 of every $30 of dividends paid out by companies Janice tracked. at&t is second for now, but is an example of a company that is planning on cutting their dividends this year, though they are giving you shares in a new streaming company called Warner Bros. Discovery, ticker WBD, to compensate for the cut. A cut always sucks, but you could make out better depending on how WB does. Warner Bros. Is killing it right now with the new Batman movie that just came out, which you absolutely have to go see if you haven't yet. It honestly might even be better than the Dark Knight Batman movie with Heath Ledger as the Joker. Yeah, I know that's saying a lot, but it's that good. Plus, WBD will own HBO, which apparently will have the new Game of Thrones prequel series in House of Dragon, and George R.R. Martin just came out and said he's seen rough cuts of some of the first 10 episodes and he's loving them. House of the Dragon follows the Targaryen Civil War, which took place about 300 years before the events of Game of Thrones. George R.R. Martin said that the writing, directing, and acting all looked terrific. He said, and I quote, "It's dark, it's powerful, it's visceral, just the way I like my epic fantasy." Those words are very promising coming from him. My guess is WBD streaming subscribers will grow nicely if it's indeed as good as it's sounding. The release date is probably late 2022. Anyways, you never know what will happen. Maybe WBD could do so well that it could be worth what might have taken years of the dividend cut to create, or it could go nowhere. I plan to sell some and to keep some. I think we'll end up doing well over the long term given their massive content base and new plans, along with their strong leadership in Zaslav and Malone, but don't count your chickens before they hatch. Well, unless your chickens are the new yummy McDonald's crispy chicken sandwich. Okay, I'm long McDonald's, but if you haven't tried their new crispy chicken sandwich, you gotta go today. I love Chick-fil-A and this one is similar. Okay, back to the list. Following at&t is ExxonMobil, and then at 4th spot on the list of most US dividend payers is Apple. Janice said that Apple is also 7th on the list of dividend payers when you look at the entire world. The only 2 companies I don't own in this list are Verizon and Bank of America, both of which I'd be happy to own. Janice also said that North America accounted for 49% of the world's dividends in 2020. You can see that European companies, excluding the UK, are next, with the UK paying out the second most in dividends overall behind the US. I actually started a BTI position recently, so it's my first international dividend payer. You can see that Canada's portion of dividend payers is in the North American circle, obviously, and you can see other countries represented as you peruse the picture. Janice found that since 2009, the US has delivered 158% dividend growth, which is twice as much as the rest of the world. But in the last 4 years, growth in US dividends has been in line with other countries overall. Clearly the US stock market has been doing really well over the last 13 years, other than the pullback this year and the pandemic pullback. So you probably aren't surprised when you look at this average dividend yield for companies around the world. When stock prices go up fast, yield goes down. Thus, the very low yield in the US is a function of very high company valuations, the sector mix, and share buybacks. Share buybacks make up a much larger portion of the cash returned to shareholders in the US and in Canada than they do in other markets. Jan has said that an interesting difference between the US and the UK is that in the UK, buybacks add about 25 cents to each dollar of dividends, kind of building on what Inversionista said. That makes sense because as you take shares out while your earnings remain the same, that means your amount per share that you are paying goes up, unlike American companies where divs normally only go up if the board of directors votes to do that. Either way, your portfolio always loves to see dividends go up. Speaking of portfolios, M1 Brokerage has a promotion running for a free $50 cash bonus for new users. The way it works is you click on my M1 referral link in the description of this video, and then either open a brokerage account and fund it with $100, or open a retirement account and fund it with $500. Then you need to keep your money inside the new account for 30 days from the date of deposit to get the free referral cash. Make sure to check the details before you sign up to see what they're offering when you watch this video. And again, I'm not going to be one of those annoying guys begging you to hit the thumbs up button, subscribe if you haven't yet, and click that bell notification. That's cheesy when they keep doing it. But honestly, you could give me a thumbs up for not having video thumbnails of myself making a silly face. That's gotta be worth something. Anyways, I do recommend that you join my free Dividend Discord chat server, which has thousands of dividend investors on it and is growing all the time. So thanks for watching this video, stay positive, and I'll talk to you again real soon. I am not a financial advisor, and these videos are for entertainment, inspiration, and educational purposes only. Investing of any kind involves risk. I am only sharing my opinion with no guarantee of gains or losses on investments.